In the last chapter, we studied break and retest. We asked whether price accepted a move beyond an important level. Now we study the other side of that idea. Sometimes price pushes beyond a level, but it does not continue. It moves through the level, triggers attention, and then snaps back. That failed push is often called a liquidity sweep. This chapter is about reading that move without turning it into a mystery. Liquidity simply means available orders. For price to move, buyers and sellers must be matched. Obvious highs and lows often attract orders because many traders can see them. Some traders place stops near those levels. Some traders place breakout orders near those levels. That means visible highs and lows can become areas where price finds activity. Liquidity is not magic. It is the market finding orders. Beginners should start with the most obvious highs and lows. A swing high is a place where price pushed up and turned down. A swing low is a place where price pushed down and turned up. When several highs form near the same area, that area becomes easy to see. When several lows form near the same area, that area becomes easy to see. The more obvious the level is, the more attention it may attract. A sweep above a high happens when price pushes above a visible high and then fails to hold above it. The candle may leave an upper wick. The close may return below the high. The next candles may move lower. That tells you the push above the high did not become clean acceptance. Price went above the level, found activity, and then rejected back inside. A sweep below a low is the opposite. Price pushes below a visible low and then fails to hold below it. The candle may leave a lower wick. The close may return above the low. The next candles may move higher. That tells you the push below the low did not become clean acceptance. Price went below the level, found activity, and then rejected back inside. The difference between a sweep and a clean break is acceptance. A clean break moves beyond the level and begins to hold beyond it. A sweep moves beyond the level and then quickly returns back inside. The first one says the old boundary may be changing. The second one says the market tested outside the boundary and rejected it. This is why candle closes and follow-through matter so much. Sweeps happen because visible levels attract decisions. Above a high, there may be buy stops from short traders and breakout buys from traders chasing strength. Below a low, there may be sell stops from long traders and breakout sells from traders chasing weakness. When price reaches those areas, activity can increase quickly. Sometimes that activity fuels continuation. Sometimes it exhausts and reverses. The reaction tells the story. Stop orders are one reason liquidity collects around highs and lows. A trader who is short may place a stop above a recent high. A trader who is long may place a stop below a recent low. Those stops become orders if price reaches them. So when price pushes beyond an obvious high or low, it may be triggering stops. That does not mean every stop area reverses. It only means activity may be waiting there. Breakout traders can also add liquidity. Some buyers enter when price breaks above a clear high. Some sellers enter when price breaks below a clear low. If the breakout holds, they may be right. If the breakout fails, those traders can become trapped. That trapped response can add fuel in the opposite direction. This is why a sweep can move quickly after the rejection appears. The important part of a sweep is not only the move beyond the level. The important part is the rejection after that move. If price sweeps above a high and then closes back below it, sellers may be responding. If price sweeps below a low and then closes back above it, buyers may be responding. Without rejection, there is no clear sweep. There's only price moving through a level. After a possible sweep, candle behavior becomes the evidence. Look at the wick, look at the close, look at the next candle. Does price follow through away from the swept level? Or does price stall and move back beyond it again? One wick can get attention, but the behavior after the wick is what makes the idea more useful. Sweeps are common around range edges. In a range, price often travels between a high area and a low area. When price pushes just above the range high and returns inside, that can be a high side sweep. When price pushes just below the range low and returns inside, that can be a low side sweep. The middle of the range is usually less clear. The edges are where the idea is easier to study. A sweep can also happen inside a trend. In an uptrend, price may pull back below a recent minor low, reject, and then continue higher. In a downtrend, price may bounce above a recent minor high, reject, and then continue lower. The sweep does not erase the larger trend by itself. It may simply be a deeper test before the trend continues. Context decides how important the sweep is. A double top sweep is a simple example. Price forms two highs near the same level. Many traders can see that area. Later, price pushes slightly above those high. If it cannot hold above them and closes back below, the highs have been swept. The key is not the name double top. The key is the failed acceptance above an obvious area. A double bottom sweep works the same way in reverse. Price forms two lows near the same level. Many traders can see that area. Later, price pushes slightly below those lows. If it cannot hold below them and closes back above, the lows have been swept. Again, the pattern name is less important than the response. The market tested below and rejected the move. Sweeps can connect back to break and retest. After a high is swept and price falls back below it, that same high may become a reference point again. If price returns from underneath and rejects, it can confirm that buyers failed to hold above the high. After a low is swept and price moves back above it, the low may be retested from above. These ideas connect, but the order matters. Not every wick beyond a level is useful. If price is chopping back and forth around the same line, a small wick may just be noise. If the level was not obvious before the move, the sweep idea is weaker. If there is no rejection and no follow-through, the idea is weaker. Beginners should avoid forcing a sweep onto every candle. The best examples are usually clear before they happen. A beginner workflow can stay simple. First, mark the obvious high or low before price reaches it. Second, watch whether price pushes beyond that level. Third, check whether price closes back inside. Fourth, look for follow-through away from the swept level. Fifth, judge the whole idea against trend, range, supply, and demand. If the steps are not there, do not force the label. The first mistake is calling every wick a liquidity sweep. The second mistake is ignoring the close. The third mistake is ignoring context. The fourth mistake is assuming a sweep must reverse the market. Sometimes a sweep leads to reversal. Sometimes it only creates a short pause. Sometimes it fails and becomes part of a clean break. The chart has to confirm the idea. Here's a practice sequence. First, mark equal highs before price reaches them. Second, watch price push slightly above those highs. Third, wait for the candle to close back below the area. Fourth, watch whether the next candles move away from the swept high. That sequence gives you something structured to study. It is much stronger than deciding after the fact that a random wick mattered. Here's the recap. Liquidity means available orders. Obvious highs and lows often attract those orders. A sweep pushes beyond a visible high or low and then fails to hold beyond it. The rejection and the follow-through are what matter. A sweep can happen in a range, inside a trend, or near supply and demand. But the idea must be clear, not forced. Liquidity sweeps help explain why some breaks fail fast. They also help you understand why price may dip below a low or pop above a high before continuing. But after a sweep or a break, the next question is often about pullbacks. How does price return to an area without ending the larger move? In the next chapter, we will study pullbacks and continuation.